Hello and welcome back to the International Business Management course. So far we have covered the curriculum of the course where we analyzed the different environments that you have to take into consideration when you are internationalizing your domestic business. So far we've covered the cross-cultural risk, also known as the social and cultural environment. We covered the political and legal system, which is also known as the country risk, and we have covered, and today we will cover the financial environment or the financial risk that could arise from the differences or the monetary transactions. So today's lecture is titled The International Monetary and Financial Environment, and when we are internationalizing, we have to highly evaluate the financial aspects of things in foreign markets, such as we have to learn the different exchange rates and currencies in international business. We have to describe the different monetary and financial systems that are involved in different markets, and we have to identify the key players in any monetary and financial system. So now that you are trying to internationalize your domestic business and you want to enter foreign markets, what do you have to know when it comes to the financial aspects of things? You need to evaluate the currencies and exchange rates. What is meant by this is that no business operates in their local currencies. You have to deal with currencies from different countries or different currencies worldwide. Now, usually these currencies fall under the 170 currencies that are used worldwide, while some currencies are used than others. We will know exactly which is the highest or the most used currency on a world or on a global scale. Currency regimes are simplifying the differences in currencies through components such as the euro being the unified currency in the Europe market. We have the dollar in Panama and Belize that is now used as the unified currency. Also, most currencies are not very convertible, which means that the dollar, the yen, the pound, and the euro are very hard to manage, or they are considered as hard currencies. These hard currencies, because they are universally accepted and preferred in international transactions, so it's very difficult to change such currencies. Now, when we are talking about exchange rates, what is meant by the word exchange rate? It is the price of one currency in terms of another. So how much is a dollar in terms of Egyptian pounds, for example? This is considered the exchange rate, the value of the dollar in comparison to the Egyptian pound. And I think we have all witnesses that the exchange rate usually fluctuates. So this means that exchange rates are very prone to changes. So therefore, exchange rates changes affect the firms in various ways, such as the cost of inputs, the sales performance, and also the market entry strategies that could be used. And we have, which as we will cover throughout this chapter, is that we have different entry strategies. And these entry strategies could highly be impacted by the exchange rate and the exchange rate fluctuations, which means that certain businesses could avoid entering markets that have highly fluctuating or hyper fluctuations in their currencies. So, as I was just saying, constant fluctuating exchange rates require international managers to keep three facts into consideration, or they have to take these components in mind when operating in international markets. Number one, we have to understand that the prices that the firm uses can be quoted in the firm's currency or in the currency of each foreign customer. And this depends on the market that I'm entering and their laws and their regulations, as we covered in the previous lecture. Number two, I have to take into consideration or keep in mind that because several months can pass between the placement and the delivery of an order, this could, or businesses could inquire or could deal with fluctuations in the exchange rate in that period of time. and this could cost them a lot of money or a lot of loss because fluctuations in the currencies and the exchanges that happened in this period. Number 3, I have to take into consideration that the firm and its customers accordingly can use the exchange rate as it stands, so we can use the current exchange rate as we are doing the transaction, or we can agree on a specific exchange rate just in case any fluctuations happen. We are already agreed upon or specified a certain exchange rate, and this is the exchange rate no matter how long the in between the order and the delivery. This is the exchange rate that will be used to avoid any inconsistencies. So as we were discussing, we are talking about the currency, or also known as the financial risk. And if you remember from the first lecture, these are the 4 risks that we have to identify, or we have to evaluate and study very well in order to ensure that we are managing our business on an international level in the most efficient and effective manner. So right now we are discussing the currency and financial risk, and then later on in the next lecture we will take the last type of risk, which is the commercial risk. And this will, therefore, we will have covered the 4 different types of risks that could arise when entering foreign markets. So let's proceed with the currency risk. What are the components that I have to take into consideration in terms of currencies in the financial aspects is the foreign exchange market. As we were just discussing, as foreign currencies, or as currencies are always prone to fluctuations, I have to understand the foreign exchange market, which is all the forms of internationally traded currencies, including foreign currencies, bank deposit, checks, and electronic transfers that are occurring between one nation and another. Foreign exchange markets are the actual place that where the buying and selling of these national currencies occur, and exchange rates are the rates that are constantly fluctuating or changing in this market. So factors that influence the supply and demand for a currency. If you recall back to your macroeconomics course, which you should have covered by now, you will remember that one of the main components that impact any financial or any currency risk is the economic growth. Usually currency or financial components in any nation are highly impacted by the economic situation of the nation. So as economies grow, this highly impacts their overall ability to control and to manage their currency and financial risks. In other words, to simplify, nations with better or more stable economic growth are definitely known to have less financial risk when operating in such nations. So economic growth is the increase in value of goods and services produced by an economy, and usually economic growth is highly measured by GDP. I think GDP is one of the most used tools or measurements to evaluate or to measure whether a nation is economically doing well or not. This is one of the highest used tool of measurement by economists all over the world, and this is the main indicator that indicates whether a country is economically stable or not. So the GDP is measured usually it's measured annually, and it identifies the production of such nations, and usually, as we have covered, or as you probably have covered in your economics courses, that the nation, the more they produce, the higher their GDP will be and the more economic stability that they will have. And this, therefore, nations who are categorized by a stable or an increasing GDP are usually driven by entrepreneurship and innovation. Usually the nation's central bank regulates the money supply and issues currencies and manages the exchange rate to accommodate economic growth or to support economic growth. And this is the hope, or this is the usually any country or any nation is seeking economic growth, and this is what they are trying to continuously enhance and improve to improve their overall economic welfare. Other factors that I have to consider when I am thinking of internationalizing in a foreign market or entering a foreign market is the level of inflation. Also, another economic indicator of any nation is its inflation rate. Usually, inflation refers to the increase in the prices of goods and services. Therefore, money buys less than before. So the higher the inflation, the less value of the currency or of the money that I have. And this is very threatening for businesses, because when you're operating in an economy that is suffering from inflation, usually this negatively impacts the supply and demand component, where economies that are suffering from inflation, they usually suffer from demands. People don't have or cannot afford to spend, so they usually are encouraged to save. And as you will see here, that usually nations that are suffering from inflation, you will find that their interest rates are positively related. So the higher the inflation, the higher the interest rates, and this promotes people to save rather than spend. So therefore, this impacts the supply and demand for products. Now, other factors that I have to take into consideration that could also influence the supply and demand for currencies is the market psychology, the government actions, and the balance of payments. When we are talking about the market psychology, this refers to the investment behavior, such as herding behavior or momentum trading. What is meant by herding behavior is that the way investors react to certain trends. So some might just follow the trend, or they just might follow what is happening by other investors. So if people are pulling out a certain market, they might just follow them, and this is called herding behavior. Or they might just be trading in certain commodities or in certain industries because this is what's in trend right now. So therefore, the market psychology highly impacts the supply and demand components, or the supply and demand for certain currencies. Also, the government actions. So the government could interfere or could subject to influence the value of their own currencies, such as the Chinese government, which regularly interferes in the foreign exchange market to keep the renminbi, which is their local currency, to help ensure exports. So some governments could enforce that certain trade transactions are done in their currencies in order to, as a way of protecting their currency and enhancing the position of their currency in the market. Balance of payments is another factor that could influence the supply and demand, where the nation's balance sheet of trade, such as investment and transfer payments with the rest of the world, and this reflects the difference between the total amount of money coming in and out of a certain country. And this is also another measurement that is used to evaluate and to criticize the economic status of certain nations. Now, going back to the exchange rate systems, we have to identify and we have to realize that, as we said earlier, the exchange rates are highly prone to fluctuations. So therefore, in today's advanced economy, currencies float according to the market forces. Their value is determined by supply and demand. And as we see, the US dollar is usually one of the strongest, and this is actually, this is a fact, that the US dollar is the strongest currency on a worldwide scale. Why is this? Because usually most trade transactions are done by or done through the dollar, or using the dollar currency as the main currency for trade transactions, and this imposes, or this actually enhances the position of the dollar in comparison to other currencies, because the demand on the dollar is always very high, therefore enhancing its economic position in the foreign exchange market. Other popular currencies used in trade transactions are also the euro, the pound, and the Japanese yen. Therefore, most developing and emerging economies use fixed exchange rate systems, and in fixed regimes, the value of currency is pegged to the value of another or to a basket of currencies at a specific rate, and this is a way to manage the foreign exchange risk where fluctuations could occur. So they try to be proactive by setting a certain basket of currencies to evaluate or to try to control this risk. So what are the different financial systems? We have the international monetary and financial systems, such as the International Monetary System and the Global Financial System. And we have the International Monetary Fund and the World Bank, and we will talk about all of these participants in details. So who are the International Monetary System exactly? They are the institutional framework rules and procedures by which national currencies are exchanged for one another. So when I'm engaging in international business transactions and I will be financially transferring different currencies and so on, I have to abide to the international monetary system that is set by such institutions. Also, the global financial systems are the collection of financial institutions or entities which facilitate and regulate the flows of investment and capital funds on a worldwide scale. We have also the International Monetary Fund, which is the IMF, and I'm sure you all have heard of the IMF. This is the agency that promotes exchange rate stability, and this is the facility that monitors exchange systems, provides funding to developing countries in order to promote economic integration and economic enhancements for less fortunate nations. And then, of course, we have the World Bank, and the World Bank is the agency that provides loans and technical assistance to combat global poverty around the world, and they are also there to promote and enhance economic integration among less developed nations. Again, who are the key participants in relationship in the global monetary and financial systems? We have the firm, we have the national stock exchange and bond markets, we have the commercial banks, we have the central banks, and we have the Bank for International Settlements. And most of these participants, it's very important to know these participants, because without them, I will not be able to manage my business from a financial perspective. These are the firms, or these are the participants that will make my financial transactions doable and a lot easier. So therefore, the firm, it's the international transactions, require firms to deal with huge amounts of foreign exchange transactions. I have to take into consideration that these national stock and exchange or bond markets, they will facilitate the trade, securities, and bonds in the handling of bonds. I have to take into consideration the commercial banks, which will be the main institute that could lead money to finance businesses' activity, and they are the ones that could serve, or they could facilitate the loan process to enhance my or to fund my international business. I have to abide to the central bank, which regulate the money supply, they issue currency, they manage exchange rate, and they also control national reserves. And I have to take into consideration or abide to the Bank for International Settlements, just in case there's any disputes or there's any activities that they need to supervise by the central bank monetary policy and other activities. So understanding these key participants and their role in the financial environment definitely leads or helps businesses when they are internationalizing to ensure that they do not follow or they do not fall under a financial or a currency risk. So therefore, In today's lecture, we covered that it is essential for any business owner when internationalizing and when figuring out or trying to identify a foreign market to enter and to do business in, they have to highly analyze their financial environment and understand the finances and the economic environment of such market, because this could cause consumers, or this could impact the supply and demand factor as we discussed. And the supply and demand factor, if it is enhanced or if it is impacted in any way, this could also impact the demand for my business. And this is why it's very important to understand this foreign market and if I will succeed in it or not from an economic perspective. Thank you, and I will see you in the next lecture.